Make a start. So just want to welcome everybody this afternoon to the third in the series of the Ensors Team of Experts events. Those of you familiar with the physical version of these events will remember that these would normally be split four ways between forensic accounting, corporate finance, business recovery, and taxation. But to make these webinars a bit easier, we're splitting these out over a number of weeks. And so this is the third in the series. And today we are going to be looking at the subject of valuation in uncertain times. The subject of business valuation, how COVID in particular will impact valuations going forwards. So speaking today will be Simon Martin. Simon's a director and an expert witness in our forensic accounting team. Highly experienced in business valuation for all types of purposes, including court reports, for matrimonial, commercial purposes, and also in corporate transactions. The way the webinar will work today is that Simon will present the formal part of the presentation. You should be able to see, for those of you familiar with using Zoom webinars, there's a Q&A function. It'd be really good if you could post some questions as we go. We'll either take them at the end, or if there is a gap and it's appropriate to do so, then I'll try and interrupt Simon along the way as well. So please do make use of that. Without further ado, I'll hand over to you, Simon.
Cool, thanks David. Hi everyone, thanks for joining us this afternoon. Unfortunately, I've had a few problems with my laptop sound recently, so I've had to opt for this rather fetching headset, but hopefully that'll work quite well. So what we will cover this afternoon, we'll start by having a look through valuation methods, just a really brief, quick recap really, and then we'll look more in depth at the effect that the current situation could have on future maintainable earnings, which is the most popular method. Is this sound okay, David? There's just a message just popped up saying that you can't hear me.
Okay, you probably just need to speak a bit more clearly into the mic, that's all.
Is that better?
Much better.
Yeah, I think I had the mic down too low. So if I just click back. Yeah, so this afternoon we're just going to cover a quick overview of the different valuation methods, and then look more in detail at the future maintainable earnings method, which is the most popular one for valuing SMEs, and then look into how the multiples were impacted in the last recession. And then to wind up, I'll go for a worked example. So these are the main valuation methods that we use. Dividend yield method is more for valuing minority shareholdings. So if someone's got, say, 5% in a company, they can't really do much with it. They haven't got much control, so it's a slightly different method. But in general, for about 90% of dispute cases, we'd be valuing using future maintainable earnings. Discounted cash flow is along the same lines, and that's actually gaining popularity at the moment. And my personal view is within 5 to 6 years, that will probably be the go-to method. I think things just change very slowly in valuation circles. There's still people that are hanging on to valuing with PE ratios rather than multiples. So it's a slow movement, but I think we'll end up going towards DCF. But for this afternoon, we'll focus on the future maintainable earnings method. So to value on the future maintainable earnings, there's 3 main phases you need to go through. So the first is to calculate a normalised income. And that is normalised. So when we say normalised, that is trying to assess what a business can make in any one standard year. And it would be normalised normally for 2 separate types of adjustment, and one will be transactions which weren't at market value. So an example of that could be a director who remunerates himself through dividend rather than salary. So because he takes a dividend, the cost doesn't go through the P&L, which then means the profit's inflated. So if you were buying that business, you'd want to put a cost in for how much it would cost to replace that person and run the business. The other type of normalisation adjustment would be for one-offs. So obviously at the moment, the situation, there's going to be a lot of those kind of add backs in future years that we'd need to adjust for. The second phase or second thing that you need is a multiple, and the theory behind a multiple is the amount of years that an investor or a purchaser will wait for payback of their investment. So in some ways, it's a bit of a function of risk, because if someone thinks that a business is really high risk, they're going to want their money back quicker, so they're going to pay a lower multiple. Whereas if you have a business that's steady, and it's got good visibility, people might be happy paying a higher multiple. And then also you do get some companies that are growing quickly and people are taking a bit of a view on what they think the earnings would be in a couple of years' time and adjusting the multiple based on that. And then finally, after you have those two things, you need to adjust for the balance sheet, because otherwise you could have two identical businesses, same profit and loss account, except one's got a £2 million property and one's got borrowings of 2-3 million. It can't be right that those two businesses are worth the same amount of money. So you need to look what a business has for surplus assets, and by surplus asset would mean things that aren't used to generate the normal ongoing profit of the business. So for example, that could be, say you have £2 million in a reserve account that's never touched, it's been there for the last 2 years, that's not really used day to day in the business, so there's a good justification that that should be added on as an addition to the price. And then there will be deductions for debt as well. So just moving on, this is how the formula comes together. So your normalized profit is times by your multiple, and that gives what we call the enterprise value. And then the enterprise value is adjusted for adding on surplus assets, deducting debt, which then gives the equity value. And this really, if you look at all of these parts of the valuation, this is really building up to where there can be a triple impact when businesses are struggling. So if you think what business is going through at the moment, your normalized profit is probably going to be lower. Your multiple could well be lower because investors see it as a bigger risk, so they want their money back quicker. And then the balance sheet could be taking a bit of a hammering, which in turn will reduce the surplus assets or increase the debt. So the first one of these triple impacts, earnings. So it's quite likely that businesses are going to be suffering at the moment and losing profit. But the thing to assess is whether this is a short-term shock or something that's going to be more long-term. And for every business, that will be different. So the thing is, when you're looking at businesses trying to assess whether they've got value, it's really taking it on a case-by-case basis, because you could have businesses that are struggling in the short term, really struggling, where they feel the shock, but then they're going to pick up quite well. And you could have businesses where this is unfortunately probably a sign of things to come, and where things have happened, it's just pushed the business world on maybe 5 years, and it could be that the business has become obsolete. I think it's also important to remember that there will be winners from this as well. We've got one business where we tried to sell it last year, and it's a really unfortunate set of circumstances. We ended up going through 3 separate deals, which all fell over towards the end for varying reasons, and it began to look like they'd left retirement a bit too late. Business was dropping off. But since this has happened in the last couple of months, suddenly their services are really in vogue again, and their business is stronger than ever. So it's looking like that might be a good one to sell later on in the year when they've got some good numbers behind them. And we've actually had one of the people that were interested last year already approached to ask how things are going. With the winners, though, I also think that there will be some that win short term, probably in the same kind of way there'll be losers short term. There'll be businesses that are used as a bit of a sticking plaster by other businesses. So a business will have a real need for something and then so use this other business's services, but it will be more of a short term thing, and where people are getting costs, because at the moment it's more necessity. People do what they need to carry on the business, make sure it carries on trading. But the longer it goes on for, people will be looking for how they can adapt their own business to cut out these bigger costs. So it's just really important to assess each business on its merits and think about whether this is going to be short term or longer term. So just to show how each sector is different, this is a graph that was put together by a Bank of England sub-panel, and it's a poll of finance directors, and it's their expected reduction in sales for 2020 for Q2, so that's April to June. The top heading, accommodation and food, I assume that's the whole of the hospitality industry in there, so that's no surprise that that's down by a long, long way. If you look at all of the others in the context of hospitality, at first glance they don't look that far out, but then when you look at the difference between construction and other production, that's probably 25–30%. If you think of the level of fixed cost that will be in these businesses, that's going to make a big difference between whether businesses are loss making by a long way or whether they're managed to scrape by on a break-even basis, because it depends really how much they've depended on schemes such as furlough to get their costs down to bring this all back into proportion. So the next thing I wanted to go through was the multiple, and this is the most subjective valuation area, and it also makes the biggest difference to a valuation, because if you're timesing say 500,000 by 4 or 5, it sounds like a very small difference, but that's putting 500,000 onto the price, the difference between 4 or 5. So it's really important to assess comparability when you're quoting multiples. And that isn't easy with SMEs because there's not as much published information. So the key is to not use any one area in isolation and to try and get a bit more of a rounded view. And to do that, we'd look at transactions that were publicised, industry indices, and then also deals that we're involved in. I know there's quite a few indices around, but some of them that we do see, the multiples quoted are so high and they just seem to be out of kilter with anything that we see on a day-to-day basis. And to give an example, I'm just going to try and use this little tool. Some of them don't adjust for property within a business. So if you had, say, a deal value of 10 million, but that included a property of 4 million, and then say profit was, I don't know, 2 million, some indices will say, okay, the deal value is 10 million, the profit's 2. So your multiple's 5 times profit, but it's not, because if you see the components of that transaction, it's actually really the 10 million less the 4 million of property, 6 million, which then when you divide that by the profit, it's about 2. Oh, sorry, I'm just getting a note that it looks like that example hasn't actually come up. So we'll move on. Okay, so where we're talking about comparability is the main thing with multiples. The difficulty in a recession is that there's less deals around. So this is data taken from Experian Market IQ of the last recession. As you can see, deal volume falls off a cliff straight away. So it's down by about 44%. And I found this quite interesting because the deal values didn't actually ever recover. And it looks like we were getting to about 2016, and they were on their way. And then probably because of the uncertainty around the EU referendum, it's caused it to drop off. And the crudely drawn line on there that I've put on shows that we probably would have been back at parity, but it would have taken about 10 years, which is quite a long time to recover from the initial drop off. I think the one thing important to say about this is that in the last few years, we haven't really noticed a drop off in deal volume. And in 2019, in the East of England, we were involved in 20 completed transactions, which put us second in the Experian league rankings by volume. And at the start of this year, we'd already completed 8 up until the start of March. So it just shows that things were really building. So it will be interesting to see what happens. So the one bit of good news that I take from this graph, or hopefully good news, is it seems there's quite a lot of resistance around 700. So this is a rolling average of how many deals complete per quarter. And it seems there's quite a bit of resistance at 700. So it bounces back off that a couple of times. So if that was the floor of transactions, where there's always going to be a number of transactions because people are deploying capital, then it could be a good thing in that we haven't actually got as far to fall this time. So it might be less of a big shock to the deal making society or industry. Yeah, so that's just something to be hopeful about. And as a team, we're talking about how many transactions, live transactions we've got on at the moment. And I think it is actually probably towards 10, and they're all at different parts of the life cycle. So there's early deals in there, there's deals that are heads, there's deals that are diligence, but it is quite reassuring, and hopefully that there will be quite a few deals that continue to happen. So that last chart was pulled together by Purda. Now, Purda are an indice which track average deal multiples in the UK, and they're actually probably my favourite one. When I look at the numbers that they talk about, it seems a lot more in keeping with what we actually see on a day-to-day basis. But the one thing about them is that they report at EBIT level rather than EBITDA. That's a really important thing to think about, because I have seen other valuation reports undertaken by people where they've applied the Purda number against EBITDA, which makes quite a difference. So just to show the difference between EBIT and EBITDA, say we had a company that had enterprise value of about 9 million, EBITDA is 2 million, EBIT's 1.5, so depreciation in there and amortization is about 500,000. So this is the same deal, same company. If you were quoting an EBITDA multiple, it'd be 4.5. If you were quoting an EBIT multiple, it would be 6. So that shows that's the same deal, but we'd always expect the EBIT multiple to be a bit higher. So if you were thinking in EBITDA terms, when you look at Purda, you'd be expecting to knock a little bit off of that. So this chart tracks the multiples reported by Purda over the last 12, 13 years, and the shaded area just shows the recession in 2008. So we can see multiples started to drop off around then. If I just add an extra part to the chart, so the recession is now shown by the red arrow, and then the shading is showing where the multiples were suppressed by. So what you can see here is that the multiple suppression actually continues after the recession. When the recession is going on, multiples are dropping down, but they haven't dropped to their absolute minimum. And I think that's got a lot to do with, well, there'll be a few things, probably consumer confidence or investor confidence, but also the lag in reporting these transactions. And that, so if you think of a transaction, say there was a transaction that was completing today, that was probably negotiated in maybe December last year, January. So at that point, nobody had any idea that this kind of thing was going to happen. And it could be that the investor still thinks that it's a good opportunity. They want to go through with the deal, but they might not be chipping the price. To get comfortable, they might be saying, okay, we're going to defer your consideration over a bit longer, or we're going to ask you to leave some more money in the business and de-risk themselves that way. If they aren't chipping the price and bringing the multiple down, then when that deal completes and then Herder capture that next month or for the next quarter, that's still going to show quite a good multiple for that quarter. And if all the deals come together in the same kind of way, obviously you'll have ones that are lower on a fire sale basis, but that will keep the multiple higher. And then if you move that on a bit, if you think deals that are maybe originated in, say, 3 months' time, that could be a much lower multiple depending what's going on and what the confidence is like in the economy. However, that deal might not complete for another 6 months after. And by then, maybe there's more confidence in the economy, but we're still seeing a lower multiple reported. So it's just something really to think about with expert valuations, especially if somebody's quoting a multiple and it's based on an indice. Is that really showing what's actually happening in the marketplace right now? So it's quite important to have someone that can cross-reference that against the deals that they're seeing. And if anything, it will probably be maybe a sharper line this time than with the last recession, just because it's such a shock. Whereas the last one, things maybe tapered off a bit, you could see things were coming. Whereas this one, we maybe had a month's notice, and at that point, I don't think nobody really realised how serious it was until business stopped as we know it. So the third adjustment to make is for the balance sheet, and that's where we were saying before about the surplus assets and the debt. And so this is the third impact, and the third of the triple impact. And if you think at the moment businesses might be struggling, they might be either using their cash reserves or they might be racking up a bit of debt, that's going to have quite an impact. So you could have things such as payment deferrals. A company may have deferred their VAT, and whereas VAT would normally be working capital and that wouldn't be a deduction to the price. If you're a buyer and there was a backlog of VAT, you'd be arguing that that isn't normal working capital and that should either be debt or it should be within the working capital pin and some kind of deduction working its way through from there. So that would increase the debt in that way. And then with the CBILS loans, you have to think that or realise that these aren't free money. So these are loans that need to be paid back, and they're being paid out on some quite high multiples in some places, and rightly so, because businesses need the money to keep the economy going. But some of these are up to 5 times EBITDA. So if you think that a business, if EBITDA is the underlying generate or underlying profit of a business without the tax, without the depreciation, without the interest, if you think a business next year, they're going to have to pay interest, they're going to have to pay tax, they're probably going to have to pay capex as well, depending on whether they can get by without doing so. So from there, your EBITDA figure is already reduced, and you talk about it, these businesses may not pay back these loans for 8 or 9 years, and they're effectively mortgaging off their profits for that amount of time in the future. So if you're thinking from a maintainable income from out of a business for maybe in a matrimonial case, that might be greatly reduced for a long time based on the size of these loans. So to finish up, I just wanted to work through a quick example. Now, this is a business that failed to act quickly, maybe slept a bit, didn't furlough people as quickly as they should have, just didn't make the other cost-cutting measures where they should have. But on the plus side, it seems like they should bounce back when trade gets back to normal. So the normalised earnings, we'd say, or in this example, normalised earnings have dropped off 50,000. So this business hasn't done too badly, really. 50,000 loss of profit compared from before to after. A lot of people would probably take that right now. The second impact, the multiple in this hypothetical industry, maybe the investors not as confident, so they've knocked the multiple down 1. So that makes quite an impact, because you're down from 3 million to 2.2 to start with, so about 25%. But given everything that's going on, it might not be the end of the world. If we look at the balance sheet, so fixed assets are down a little bit, probably because of depreciation. Debtors are up, which might not be a good thing because they might have been struggling to collect them in. But then on the plus side, stock's up and cash looks really healthy. So that actual bottom line should read assets rather than net assets. But the second half of the balance sheet is where there's a sting in the tail. So trade creditors are up. Your VAT and other taxes are up, maybe because they've made deferrals, and they've got a Sybil's loan in there as well for 750. So then that all comes together to make the net assets, as that should read at the bottom. They're down from 1.4 million to 400,000. And the effect that has on the final calculation. So you see, we've gone from a business that's worth just under 3 million that's only lost on an ongoing basis 50 grand of income or profit per year. And because of how much debt is within the business now and the knock-on effect of the multiple, the equity value has gone from 3 million or just under 3 million to just over $1 million. That's quite, some ways, a far-fetched example, but it's not beyond the realms of possibility at all. If you look at the balance sheet to take on that loan just to hold up trade, so it means a sizable loss has been made through the lockdown period. But I just think that's a really important thing to think about, especially for maybe family lawyers. If people are coming to you and saying after this period, saying my other half's business must still be worth considerable amount of money because it's still trading well, it's really just to think about what scars have been left behind. So they may have weathered the storm, but then there could be the scars that are left behind on the balance sheet. And then just to finish up really quickly, I just wanted to say about the net asset basis, because that's the second most popular method for valuing smaller businesses, really. And historically, you may have just looked at what was on the balance sheet, say net assets were $1 million, maybe uplifted for any property that was undervalued, maybe brought in some extra latent tax charge, but there may not have been much adjustment needed to show the value of the business against the balance sheet. If a business is struggling, then the breakup basis could apply, which means that you've got a bit more of maybe a fire sale situation, and in that situation, assets are going to be worth less. So your fixed assets could be worth quite a bit less if you need to realise them straight away. And same with stock. And with debtors, it's always difficult to recover debtors if a business is closing its doors. But given everything that's going on now, and that people probably see it as self-preservation mode, if a business was going under, would people really feel that guilty about not paying the debt that they owe? So yes, just thinking about whether the sales will achieve the balance sheet value. We had a distressed sale a few weeks ago. That was a business that did have a sale process ongoing, but then it was really, the industry that they were in were really hit by coronavirus. So the buyer pulled out and it became a distressed sale. We tried to market it as a business, but that was difficult. We couldn't find anyone to take it on. So we sold the property. It's quite a big property, and that was not far off the same value as the business anyway. But it was difficult to find a buyer to start with, especially at the moment, because you're looking for someone who's a cash buyer and so they have funds to deploy and they've got quite a good risk profile. And to begin with, they offered us probably about 30 to 40% under the market value, and their rationale for that was they've been around in recessions before and they know that there's going to be some great opportunities coming up, so they were keeping their powder dry. We did manage to settle on a small discount. I think it was probably about 6% under the book value, which was actually a really good result, and probably as this goes on, depending on the asset in question, that might be a bit more difficult to get a sale of close to that asset value. I mean, an example in the press at the moment is Flybe, where I think their fleet of planes was valued at something like 190 million at the start of the year. And I think that's half now. It might be down at about 85 million. That's an extreme example because the industry that they're in, but it's just something to think about. So in conclusion, this is a fast-paced situation with lots of unknowns, and it's difficult to really assess fully what the impact will be, but I'd say you always need to be thinking about the triple impact on the earnings basis. So the fact that your earnings will be lower, the fact that the multiple could be lower, and the fact that the balance sheet could have quite a bit of debt on it. Second thing to think about, is the multiple fair, or is there a timing lag in the published data? And then finally, that balance sheets could be bearing the scars of weathering the storm, and they're being encumbered with more debt-like items. But there will be success stories though, so it's not a case of all businesses now are worth less than before. There's going to be industries that are a lot more attractive than before, and the kind of thing they do is stickier, and they'll generate probably a better sale than they would have before. So that was everything.
Thanks, Simon. Yeah, we've got some questions come in.
Yep.
I might answer the first one actually to see what it looks like. So the first question was, do many deals get generated from administrations, or I guess the question is really insolvencies generally? The answer to that is yes. I think probably the follow-on response is we're not seeing that yet very much, and that's exactly the same as what we saw in sort of 2008 as well. It takes a bit of time for those types of opportunities to come out. That said, I think the insolvency market is busier than we anticipated it to be this early on, in what might be termed otherwise a normal recession. This is nothing like a normal recession. I suppose the follow on again on administration is that normal valuation principles for buying businesses out of administration kind of go out of the window. You're generally not talking about valuing on a maintainable earnings basis that Simon's talked about here. You're normally talking about making an offer for the assets, free of the liabilities, and then generally a sort of nominal sum for goodwill, depending on the state of the business. So we will get more deals from administration without doubt, but we're not seeing them just yet. Another question I was going to say to you, Simon, was you talked about the industries earlier, the ones that are sort of more or less impacted or expected to be more or less impacted by a turnover reduction, but which industries do you think will be the most challenging to value?
That is an interesting question. I suppose it'd be the ones where there's quite a disparity between how businesses within them have felt the impact. So if you have an industry, say like hospitality, and the whole industry's feeling it, it will be a lot easier to find comparable information, or maybe tar with the same brush is the wrong term, but it will be easier to see the average for the industry. Whereas if you have some industries where there are real winners within there, but I think they will probably be the most difficult ones, because especially in dispute-based scenario, people don't always want to offer up the latest financial information anyway. And if somebody is doing quite well, it might be that they don't produce those figures or say they don't exist. That's quite I suppose following on from that as well, one thing that I thought about earlier is that in disputes, if people are saying that financial information doesn't exist, it'd be quite interesting from a tactical point of view to ask for what they've provided when they've asked for maybe funding under CBILS or to the bank. So there probably will be more financial information than maybe before. It's just that you might have to ask the right questions to get it.
Yeah, don't disagree. I think that's probably it on the questions, unless anybody's got any others that they want to quickly type. I just can't see any more coming through at the moment. But it's been really interesting, Simon. Thank you. I think lots of different takeaways to take from that. Beware the stated multiple. I think that's always been the question or the issue that we've had to deal with in valuation generally. It used to be the valuation that somebody would quote down the pub, but clearly we're not going to be down the pub anytime soon. So I'm not quite sure where people are going to get their multiples from. And then I think really that point about the triple impact on valuations, whether this is for commercial purposes or for a dispute valuation, I think is really, really important for people to remember. So at that point, it's just left for me to wrap up. So thanks to Simon for delivering a really interesting presentation there. Thanks to everyone for attending. We really appreciate you coming along and listening to the webinar. There's still space to sign up for the future webinars. There's another 2 to come. There's a corporate finance one next week and one on personal taxation the week after, so feel free to sign up for those. We will be sending a feedback email out to you all, so please do give us some feedback on how you feel the webinar went and any other pointers that you've got. And at that point, just left to say thank you once more and wish you a pleasant evening. Bye.